What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is September 29th of 2020. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I want to talk about why I very clearly believe that the market does not trust the Federal Reserve's statements of not lowering to negative interest rates and not further printing mass amounts of money, commonly referred to as quantitative easing, and why this is probably the most important thing we need to be analyzing when talking about Bitcoin's potential to grow to a multi-trillion-dollar asset. It has a lot to do with these actions, so I hope you'll stay tuned with me, and let's just go ahead and dive straight into it, guys. So we'll come back here to Bitcoin in a little bit, but first we have to talk about the macro perspective of what's going on with monetary policy over at the Federal Reserve. So as you all probably know, the Federal Reserve is the central bank of the United States. It dictates the printing of new money, the management, the rising and lowering of interest rates. And because of this, it has a lot of weight on the economy and the performance of a wide range of different assets, from stocks to bonds to properties and even to cryptocurrencies in the long run. But we have to talk about the current status of central banks. You know, I haven't actually been talking too much. I've been talking a lot about DeFi recently, and I haven't gotten to talk too much about what's going on over the Fed because the narrative hadn't changed too much. It was basically going about printing more money, eventually inevitably getting to this place that we believe it's going to go to, which is negative interest rates, as we've been at rock bottom interest rates for some time, and the underlying economy hasn't fully recovered. But the Federal Reserve has been claiming, it's aiming for inflation, it's aiming to do all this stuff. But the big statement that everyone was listening to here that was definitely new in regards to the Fed stance is that it was not going to be further printing new money, and that it was not going to be lowering interest rates. Now, I think we all know that it's very difficult already for people in the general public to trust banks and institutions, but it has become very clear that the market does not trust the Federal Reserve. And this is the biggest problem on the Federal Reserve's hands right now. It's failure to communicate trustworthy information about its decisions or its future decisions, or to see in the future what it's going to possibly be able to do. Because, quite frankly, the track record here has showcased the opposite, that the Federal Reserve does not know how to stick to its word and deliver truthful statements on where it's going about in regards to monetary policy. So I want to go ahead here and talk about the most telltale sign that the market is not only signaling lower interest rates, but that it very clearly does not trust the Federal Reserve. And I know this is going to be crazy and shocking for you all. This is traditional markets as well that are signaling this, not just cryptocurrencies, nothing of the sort. It's actually probably one of the most boring markets that many of you probably don't watch. And I don't blame you for it. I don't like watching it that much either, outside of for the fact that it gives us a lot of great signals for the market. But I highly recommend you all start watching these values and add them to your watch list and basically keep an eye on them. Today we're going to be talking about the yields on government treasuries, more specifically U.S. treasuries, right? So these are basically government bonds for the United States. They are IOU notes, they're promissory notes that I basically give, for example, just to simplify it, $100 to the federal government for a certain type of treasury that has a certain maturity date, and then I not only get my principal back, the money I gave the government, but also some type of yield on top of it, right? That's the general premise of it. Now, treasuries are a massive market, as we will talk about in the sense of scale later on. To put it in perspective, it is a multi-trillion-dollar market, tens of trillions of dollars, and this is just U.S. government bonds. We're not even talking about the global bond market, which is over $100 to $150 trillion when we're considering all of the government bonds, okay? So, keeping this in mind here, there's an important dynamic to understand when it comes to the bonds, and that's not only the price of the bonds, but the yields. That's specifically what most people are focusing on. People buy government bonds hoping that, generally speaking, the price will hold up, that over in the long term they may increase, but generally speaking, that they can hold the government bonds, or the treasuries in this case, in order to get some kind of yield. And yields are, in a sense, dynamically correlated, very strongly correlated, with increases or decreases in the federal funds rate. When the federal funds rate decreases, one of the key metrics that the Fed, or one of the key tools that the Fed has in its arsenal to, so quote unquote, stimulate the economy, when they lower interest rates, treasury yields go down. And generally speaking, when the federal funds rate goes up, treasury yields should go up, right? But one thing that a lot of people don't know is that because the U.S. Treasury yields are dynamic in the market and due to people buying and selling bonds, these yields will increase or decline. It can actually be a great precursor to understanding where the Federal Reserve is actually going to be taking monetary policy. It gives us a sign of what the market actually believes the Federal Reserve is going to do. And let's go ahead and just take a look at the track record here in the short term. And then we'll take a picture at the long term, which is going to be even more proving to our point here. So ever since back here in November of 2018, we have been setting in lower highs for the U.S. 10-year Treasury yield. This is probably one of the most important treasuries out there. Now, of course, we're going to look at a few other ones just to get a broader perspective, but this basically is a 10-year maturity settlement treasury in this case. So, again, one of the longer-term ones. So the yield back here in November 2018 was 3.25%. Not too bad. Hedge against inflation, or at least what the Fed states is the inflation rate. And, more than anything, is way better than a savings account, etc. Right? There's a lot of benefits to this kind of yield. Well, ever since back then, we've set in a lower high, 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 a lower high. You get the picture. Going all the way down to dramatic levels after the Federal Reserve, and you can more specifically see it here, going into March, the Treasury market was anticipating a massive Federal Reserve rate cut. Right? This was even before the Fed had even enacted major cuts to the federal funds rate. You can see how it already reacted before the Federal Reserve came to the rescue in this sense for financial markets. And we've been still setting in lower levels ever since. Now, the Federal Reserve, if we're listening to the statements of Jerome Powell, who's the Fed chairman, who we can see here in this photo, if we're listening to what he's saying, they've stated in the previous FOMC meeting that they will no longer continue printing more money and that they will not step into negative interest rate territory. This is not a stance that the Federal Reserve wants to take. Well, quite frankly, with these lower highs and getting very close to the bottom that we set in for Treasury yields, where we went down to new historic lows for the 10-year, the market's telling us a different signal. The multi-trillion-dollar Treasury market is basically acting as a betting market in a sense, saying, we don't believe it. We don't believe it one bit. Take a look here at the longer-term chart here, though. Right? Ignoring these kind of short-term drawings, take a look here at the monthly chart. So this is taking a step back all the way to the 80s, the early 80s here, 1980, to where we are today for the yield on the 10-year Treasury. Take a look at this chart here. What do you notice about it here? What I notice right away, and I think most people will get it off the bat, is that it's been on a general decline. And we know this about, interest rates. If you look at the federal funds rate, it used to be that the federal funds rate was upward towards 8 to 9% back in the 80s, maybe even higher than that, depending on what data models you're looking at. Generally speaking, has been going down. It's almost a mimic of the federal funds rate, not directly, but very closely correlated on the longer term scale like this. But we can see here that as we've been going down, we actually have this kind of lower term support channel here, right? That's been tested ever since the late 80s, 1986. So we set the last low here in the line here in July of 2012. Where does it look like we're going if we're going to set in our new low on this line? I don't know if you all can see that. That's a negative number. It's about negative 0.42%. Right? And this is me just kind of roughing along the line here. We don't know exactly when it's going to touch down, but even if it touched down tomorrow, right, and made support with that line, it's going down to negative 0.27%, right? Somewhere in that ballpark range, a fraction of a percentage in negative territory. For the first time, the 10-year Treasury yield might go into negative territory sometime here in 2021, in 2022. We don't know exactly when. It could push sideways here for a little bit and come back down. We've seen it here before. But eventually, it's probably going to come down. At least history's shown us that it's going to come down and test that. And this is not just the 10-year yield, right? This is also the 2-year yield. Take a look here at what's been happening since November. Lower level, lower level, lower level. Continuing on here, we have COVID happen. And now we're still setting in lower levels. We are squeezing against that support level here. We're getting so close here to a catalyst moment where the market is signaling that the Federal Reserve is going to do something very, very soon. If it wasn't the case and that the market was confident in the Fed's word, you would be seeing these yields bouncing up. And who knows, it might happen. But right now, the market is not signaling that. Take a look here again. So we go to the long term here at the 2-year, right? A little more kind of widespread on the yield, going from 1.3% here to 5%, down here from practically nothing to almost 3%, right? We have these kind of wacky yields here in this case, but generally speaking, lower highs every single time, lower support levels. What's going to be the new support level if we were nearly at 0% here this time? We're treating that as resistance now. If you really want to draw a line across here, in this case, it was support back here in 2011 to 2012. And now we aren't able to get above it. This is the new resistance level. What does that mean our new support level is going to be? Well, we can already see here on the chart, it's probably going to be negative territory. Plain and simple, guys. There's no need to overcomplicate this. And on the shorter term yields here, the 2-month in this case, right? We've had a dramatic drop down. The yield is practically non-existent, and we already went into negative territory on these yields. And you want to know how manipulative they are at basically the Treasury Department? The Treasury, on their official website, didn't even mention on this day that it went into negative territory. They just said it was at 0%. So no yield, right? If that wasn't already bad enough, they didn't mention that it had a negative yield. If you check their website and you go back to these dates, you'll see that it was 0%. Maybe they changed it since then, but I know for a couple months it was still sitting there. They basically lied about that, but they didn't share the proper data. Now, let's go ahead and talk a little bit about why this is important, guys, because I know I've rambled on and off, and you're like, Nick, okay, why is this so bad that these treasury yields are going to negative territory? I don't own any treasuries. It doesn't really play a role for me as an investor. Well, it actually does play a big role, because if you're owning digital assets like Bitcoin or gold and silver, or assets that are seen as a hedge, in this case, against the mass, depreciating investment perspective and thesis in bonds, then you are set in for a very, very good ride. And I'll explain why. There are two things that negative interest rates tell us, right? If the Federal Reserve steps into negative interest rates and continues printing more money, it tells us in this case that your dollar is going to be worth more, right? Your dollar is going to be worth less. My apologies. No, your dollar is going to be worth less, right? No matter what the Fed says the inflation rate is, your dollar is going to be worth less. And along with that as well, with negative interest rates, you are going to be penalized for being exposed to either savings or having your money in treasuries. In the United States right now, there is clear statistics here. You can find this on Value Penguin here that actually state the overall amount of savings in the United States. And right now, it's $9.2 trillion sitting in savings accounts. This was back in June of 2018. This is before the Fed printing mass amounts of money. You want to guess what the savings is now? Probably well above $10 trillion. Above $10 trillion that are earning nothing in a savings account on average, earning an average interest rate of 0.06%. That is the average savings account rate in the United States. Practically nothing. That is about to turn negative if the Federal Reserve goes through with negative interest rates. But another even bigger picture when we're talking about financial investment instruments is the overall treasury market. The total value of government debt, which is what treasuries are. This back here, the latest statistic, reads that treasuries are coming in near around $30 trillion. What happens when the yields on some of these treasuries, just even some of them, go negative? What does that do for the world reserve asset? Right? Just like the dollar being the world reserve currency, treasuries, you have to bear in mind, guys, are the most respected and trusted global asset in the world. They are used in formulas for portfolio performance, like the Sharpe ratio, as guaranteed performance, right? When you're comparing like, oh, I made 5% in the stock market, you look at the Sharpe ratio, which factors in what you could have just earned putting your money in U.S. treasuries. That's how trusted they are. And now, this multi-tens of trillions of dollars in value could possibly poof into thin air when we go into negative interest rate territories. I think people, generally speaking, are going to massively flee treasuries. They are going to massively flee having their money in savings accounts. We're already seeing it now. For example, at Digifox and stuff, we've been seeing people really excited about the high yields you can get in crypto markets. People have been going to different assets like Bitcoin just to escape this type of negative interest rate territory. They've been buying stocks. They've been buying different types of assets, properties, whatever it is. Anything that gets them away from these potential negative interest rates or negative yields. So again, this is the chart you want to watch. This is what you want to focus on here. And above all, if we're thinking about it here, there's trillions of dollars locked up in savings accounts markets, trillions of dollars locked up here in U.S. government bonds or treasuries. And we're just focusing on the United States. We're not even talking about European markets, which have already had a long history alongside Japan of negative interest rates, and the fact that many other economies, Bank of England recently stating that they're considering negative interest rates, more regions of the world starting to see this as the new normal, and hundreds of trillions of dollars of assets locked up in either savings or government bonds. What do you think is the one asset in the world that is going to give you something that is not tied or correlated to the actions of a federal government or of a central bank, doesn't pay you a yield but doesn't penalize you for owning it, and also can't be printed into oblivion? It's cryptocurrencies, Bitcoin, Ethereum, digital assets that are autonomous from the monetary policy of central banks. It has a lot to do with the printing and the lack of printing thereof in crypto and the lack of penalty for owning it. It used to be that you could get a crazy yield back in the day on your money. You could hedge against inflation. You could do well. Saving for your future made sense. And it doesn't make sense anymore if you're using traditional fiat currency in the traditional financial system. It just doesn't make much sense. And this is why Bitcoin as an asset and other cryptocurrencies alike are so valuable. The premise that they offer to financial markets it's immeasurable how valuable this is. So all in all, guys, I hope you continue to watch these metrics. Again, if there's anything, watch these metrics. Don't get caught in the short-term noise of what Bitcoin's doing in regards to price today or tomorrow. It doesn't matter. This is the most important thing you can watch. And you can see here very clearly that the long-term Bitcoin's been doing well. Don't worry about it, guys. Focus on the macro perspective. The trillions of dollars that could outflow these markets to prop up Bitcoin as an asset. It's going to be needed. Bitcoin's not going to 100, 200K like a lot of people have been talking about in this next cycle anytime soon until we get those inflows. Markets are a game of inflows and outflows, and that is another very important element to keep in mind. But if you like this video, guys, please drop a like and consider subscribing, hitting the bell icon so you don't miss another video. And one last thing I just wanted to tell you all about is that we are coming to a close here for our equity crowdfunding for Digifox. Talking about this topic of getting high yield on your savings, right now with our integration of Celsius Network, users can get 10.94% interest on their stable coins. Crazy if you can get it in this case, right? So right now we've raised up to 530,000. We've gotten a lot of traffic here over the last few days. We're closing it in 3 days and 15 hours. So if you guys are interested, please consider checking out the link in the description if you want to participate. It's open to everyone. But all in all, guys, above all, I just want to let you all know I really appreciate you all for sticking with me and going through this crazy journey. We've got lots of things more to discuss here in the coming future, and I'll see you all in the next video. Take care, everyone.